Hello, everyone. Hello, hello, hello. Welcome to the Money Level Show where we think, act, and prosper. Here, we focus on changing financial trajectories and building legacies. Welcome here. If this is your first time, today we got some good topics to get into because this is talked about a lot on FinTwit, or I guess it's called FinX now, where financial experts talk about the 2 and 10 year charts. And I want to pretty much unpack that because that's something that's been thrown out there and many people may not understand it. I want to dive into that today. And what does that mean for recession? Because historically, when these charts are inverted, that means that recession is on the horizon. So, that's what I want to talk about today. Sorry for you all that I haven't been on in a couple of days. I mean, that isn't very long. I used to take a longer hiatus than that, but um, had some things going on. Now I'm back, so that's all that matters. And if you're tuning in today, be sure to hit the like button. Be sure to drop a comment so that I can acknowledge you. Hit the subscribe button if you haven't yet. Would love to hear from you. So it's kind of late. Sometime I got my late bugs that get on, um, my night owls. We're going to get into it though. So let me just pull up my Facebook tab to see if anyone on the book is tapping in today. So, all right, let's see. I got one viewer. Yeah. Let's go. Shout out. All right. So we're going to go ahead and jump into this. All right. Here we go. Boom. All right. People starting to show up on YouTube. Where y'all been at? I know I've been gone, but it's good to see y'all. Good to see y'all. So I'm going to share screen. Hang on. Da-da-da. Here we go. So we're going to look at the 10-year yield, which for those that don't understand that, we're going to go ahead and tap into this. All right, so this is a 10-year yield. So the 10-year is pretty much a treasury, it's a treasury note. So a treasury note is the government debt. So pretty much the government will sell treasury bills, notes, and bonds to fund their spending, right? So the 10-year is a note because the 2 to 10 years is a treasury note. So currently the treasury note is paying about 4.32%. This is on a max chart. So this goes back to the 80s. This is when interest rates were really high. They were paying 11%. That was in the 85. They were paying more than that before then. However, if you go back to the 5-year or the 1 year, you can see that it's a lot smaller. So when you see these big dips like this is when the Fed was cutting rates after the pandemic. As you can see, the dates here, February 3rd, 2020, and then the Fed, eventually cut rates. Boom. When you cut rates, when the Fed cuts rates, then you're not getting as much on your borrowing from the government or on your lending to the government. So, for example, this is at 0.589. So that means that you're getting 0.589, a half of a percent, or 60% of half a percent um, on your money that you're lending to the government for 10 years, right? So this is the issue that happened with Silicon Valley Bank and many other banks who actually bought a lot of bonds and bought a lot of notes during this time. So they bought these long-term debt instruments. So they're saying like, okay, yep, we're going to put money in here. The government's going to pay us back in 10 to 20 years. However, you know, they were only getting paid half a percent. And then we had the Fed raise interest rates the fastest as it's ever risen in its history, I believe. And so now these same instruments that the banks were buying down here are paying 4.32%. So the banks were losing money when they needed to get liquidity. And so that's why Silicon Valley Bank and many others went down, and some had to get bought out and stuff like that. Just a fact. Just wanted to give you all that, just so you know. Um, if you're tuning in with me, be sure to drop a comment, please. Yep, let's get this in the algorithms, y'all. Let's get it out there. Let's get it out there. So that's how the treasury yield works. So not right now, the treasury yield is inverted. So what that means is that the 2-year note is paying more than the 10-year note. And there's this good article here that really breaks it down as far as like how this works. So why is the 2-year paying more than the 10-year? Because the 2 years is short term. So right now the government is providing treasury bills and notes, short-term instruments, right? That people can buy, or that people can buy and lend money to the government at a higher interest rate than those who lend money to the government at a longer term time frame. So that's what it is. So this is an example of the yield curve. So as you can see, the 2-year back in 2010 was paying, about 1%. The 10-year was paying close to 4%. And then you got all the way to the 20 and the 30-year, which were paying about 4.5 to close to 5%. So that's a yield curve. Then you get to so these are pretty much like they talk about how the curve tends to flatten when investors expect an economic slowdown or a recession. So when you see here, I mean, this isn't these aren't flattened, but these show, well, actually this kind of shows. So these are the 1 month and all of that, right? So here's the 2-year, and then you get to the 30-year over here. So the 2-year was paying 2.44%. The 30-year is paying 2.44%. So you could lend money to the government on a short-term basis and get the same amount of yield as you would on the 30-year basis. And so why do people do this? So for example, whenever say a recession happens, and then that's an economic downturn, many investors fly to safety. They fly to bonds, right? They'll fly to 30 years, 20 years, 10 years, because they expect that this is a safe haven, right? It's supposed to be a safe haven, but then it's also they expect that when the economy turns back around, that inflation is going to pick up. So they want to lock in rates while they're higher, because when the economic downturn begins underway, the Fed starts to cut rates. And so they can lock in a higher rate while early before the Fed starts cutting rates, and then they won't be able to get as much yield. And then they also anticipate inflation picking up, because when the economy turns back into a good economy, or it turns around, then you have more production, more jobs, or people are getting jobs again. You have more people driving, using natural resources to get around and such. People start to spend more, all those different things. So investors expect that inflation is going to pick back up, so they'll fly to these safe havens, at a higher percentage rate. And then the Fed usually cuts rates, and then you begin to see this curve start to steepen. So this is a negative yield curve. As you can see here, when the curve goes up, these are recessionary times. So this is the 2-year and the 10-year U.S. Treasury yield, and this is from 2022. This is not have 2023 with the rate hikes that the Fed has implemented now. I mean, this year. So as you can see, the yield curve inverts. So that means that the 2-year is down here. It pays more than the 10-year. And this is usually a indicator for over the last century that a recession is coming whenever the 2-year pays more than the 10-year. And currently right now, this was in 2022. Right now, it's less than that. I think it's about right here, about 0.66 or something like that. So it's about right down here. So then whenever the recession hits, people will fly to 10 years or 30 years, and you'll begin to see bonds start to get a bid, and people will lock in the higher rate for a longer period of time. So that's what that means, right? So here, when it goes up, that means the 10-year is making significant amount of percentage points over the 2-year. So for example, the 2-year was down here at um, this was the spread between the two, and then this is the spread between the two whenever the recession hits. So you can see this happen multiple times. 1980, boom, goes up, comes back down, inverts again, goes up again. I think this was 87. And then you can see the 1990, it starts to go up, boom, starts to come back down, Fed's cutting rates, right? And then you get to 2000, and then it goes boom again. That's the .com, so as you can see, like the global financial crisis, and then you had COVID, which was a short-term recession that they printed their way out of. So that's pretty much how that works. Hey, what's up? What's up, cousin? Corey, good to see you. Good to see you on. Good to see you on. Yeah, appreciate you tapping in and everything. I didn't know the comments from Facebook pop up on here on StreamYard, but man, appreciate seeing you, man. Rest in peace, Uncle Junior. Yeah, so it's good to see you though. So yeah, so that's pretty much how the inverted yield works. And they have some other things on here that shows like, okay, the yield curve steepens when investors are anticipating a period of growth, such as a recovery from the financial crisis. So for example, here you can see the 2-year 2007 was paying more. It was paying 4.8%. The 20-year, and then the 10-year is paying 4.68%. So the 2-year was paying more than the 10-year. It was inverted, and it pretty much kind of flats the curve. And then you get and then you get to 2008, where people begin to flock to the longer term debt instruments. So you can see that the 2-year ends up going from 4.8% down to 2.8%. People flock over to the long-term bonds and notes, right? So the 10-year goes up. And this is during the recessionary period, right? 2008. You begin to see this yield curve steepen even more, right? It steepens even more. And then, you begin to see that that the 30-year begins to come down as well. So that means that like the Fed starts to cut rates and things of that nature. So this shows the federal interest rate. So pretty much the Fed hiked rates, they paused, and then they cut rates. They started cutting rates, and then it looks like they cut it even more during the recession down to 0%. So, and during this time, the yield curve was flat 2 years before, and then it goes to the 2008 global financial crisis. So the next tab I just want to share. These are the auctions for the treasuries and the bonds and the bills. So if you don't know what a bill is, treasury bill is anywhere from, I think, 8 weeks to 52 weeks. So 8 weeks to a year, or no, actually 4 weeks to a year. So, and then you have the treasury notes, which are 2 years to 10 years. And then you have the treasury bonds, which are 10 years to 30 years. So yeah, so here we go. These are the auctions for the last, I think it's the last 20 auctions for Treasury bills. As you can see, 13-week, 26-week, da da da. These are paying 5 um, 4%, 5.3%. These are paying pretty decent interest rates, right? So these are on the short term. And this is how you can tell the yield curve is inverted, because the short term is paying more than the longer term. Then you get to the Treasury notes. Treasury notes, 3.9, 4.398, and goes on and on, right? The 10 years paying 3.7, so it's like, okay, well, the short term is paying you, I could put it away for a year at 5.3%. But if you put it away for 10 years, you're getting paid 3.37%, right? Then when you get to the 30 years are starting to pick up. So they're starting to pick up at 4% and such. And so that's pretty much how it works, y'all. So this is how recession is signaled when people say that the 2-year and the 10-year is inverted. And yeah, neophyte, I am up late, man. I had to get a video in, trying to stay consistent, and everything. And so yeah, I had to get a video in. Tomorrow I got a big interview to do, and then yeah, but been navigating a few things this week. So yeah, but I'm still here. Appreciate you tapping in. What you been stacking lately, man? Whatever you've been stacking lately, I want to know. So that's pretty much how it works. So I hope that was helpful for you all, as we learn more of these financial dynamics within the markets, because it's good for us to know what is happening. So what the charts are saying right now is that thanks, Henry, appreciate it a lot. That's nice. Good catch you, constantly. You've been doing such great. Yes, appreciate you. Oh, this is Max. Okay. Hey, Max, appreciate you. Hey, thanks. Hey, if this is Max from the Rule Symposium, Max from the Rule Symposium. Yep, exactly. Exactly. Hey, are you going to New Orleans? Are you going to New Orleans? If you're going to New Orleans, you got to be sure to click my affiliate link and buy your ticket through my link. All right, please. Yeah, I have my affiliate link through the New Orleans. So yeah, if you could do that, that'll support the channel and everything. Neophyte, you said dollar cost averaging stock is better than gold or silver. Yeah, I mean, it kind of just depends. I mean, gold and silver is in your insurance for your dollars, right? For your cash, right? So just like how you insure your house or your car and such, gold and silver insures your money because it is money, right? And so that's the reason why I stack. I mean, mostly if I do investment, I'm gonna do any investment. I'm gonna do. I'll probably do some gold stocks or something, to kind of speculate in that area, because those are very cheap. Um, uh, those are very cheap right now. So the gold and silver stocks are cheap. BRKB, Berkshire B. We're gonna go look at that. We're gonna see where it's at right now. Max said, I've been heavily debating it, but yes, of course, I want to reach out to you and build with you. I'm sure we will soon. Yep, looking forward to it, man. Looking forward to it. You got my email, and you may have my number too, but I think you got my email. So appreciate you tuning in and everything, man. It was good meeting you and everything. So, so yeah, we're actually gonna look at Neophyte. Keep talking about Berkshire B. We're gonna go look at that real quick. We're not talking about Berkshire A, right? Because I sure can't afford that one. Let's see. All right, so you got some positions in Vizsla, HYMC. Okay. Let's go look at these. Let's look at Berkshire. Berkshire Hathaway. Okay, so let's see. Where is it? This is on the day. Year to date, Berkshire continues to climb. I mean, it was at what? 293. Now it's at 350. So it's been climbing. Last year, when the dollar spiked high, it was down to 264. So that would have been the time to buy right there. I would have been throwing some cash in there then, or during pandemic lows. Let's see, the pandemic lows was Berkshire was at 170. 170. This was after we had a liquidity shock, right? 170. Now it's at 350. So it's still pretty high. I mean, it's still, see, it said it's all-time highs. So the question is, do you think this can go lower? Do you think Berkshire B can go lower? It's kind of high right now based on the historical chart. Yep, it's still kind of high. So yeah, I mean, this would be something I would look into, but right now, it's looking like, let's see what it's just trying to see if it had any, let's see, holders. Let's see who holds the stock. You do got some big players holding this stock for sure. Vanguard owns 143 and a half million shares. BlackRock owns 100 million shares. Bill and Melinda Gates, 25 million. Morgan Stanley, T. Rowe owns 10 million, 11 million. Top mutual fund holders, the S&P ETF trusts, Vanguard. So yeah, I mean, you got some big holders, right? Now the question is, if these holders start to liquidate in the midst of an economic downturn, that's a lot of capital. That's a lot of capital going out. They control that market, so you have to be very careful. Let's see. The other positions I got, and simply for the fact Eric Sprott owns 3 of them. Okay, so yep, Vizsla Silver. I'm sure they took a dip right now. Let's see where Vizsla at. Yeah, because I know silver been kind of plummeting. Yep, silver Visa was at $1.58 earlier this year. Now it's at 95 cents. See on the year chart. Yeah, see these are at super lows. This is what people are talking about. These are very cheap. I mean, even looking back to March 2022, it's at $2.20. Now it's at 95 cents. So these are very, very cheap. That's what many people were talking about. There's a lot of gold miners. Let's see what Pan American silver is at. 15. So it kind of had a little jump today. It's still down there. Not near the COVID lows yet, but it's down there. So it went up to 37 in 2020. Yeah, so these are pretty lows right now. I mean, yeah. So yeah, some of these companies, hey, neophyte, there's a lot of companies right now. Nvidia is a winner. Would you touch Nvidia? Let's look at Nvidia. She's down 2% overnight. But it's still way up there. Yep. I mean, this joint done popped up. I remember my cousin was telling me back to buy a call option back here. I didn't do it, but I would have been up quite a bit of money if I did. I would have been up quite a bit of money. But who knows? You can lose money, you can gain money. It's all about assessing your risk and not deviating from your plan. Or if you're gonna speculate, you can speculate. Me, I didn't feel like speculating during that time, so and I probably couldn't have held through all that volatility. But yeah, I would have been up a lot. The thing is like even when people like these are all hypotheticals, right? Or theoreticals. Like if I bought it, then who's to say I would hold it all the way until it's high? Like nobody does that, right? Nobody does that. I mean, probably very few people like don't time tops and bottoms or whatnot. If you're gonna buy you could buy multiple shares. If you could buy multiple shares and then you can release some of those shares as the price continues to go up. That's what I'm doing with uranium. Like, with uranium, I'm buying shares and because like first of all, it's a long-term outlook. So my thing with options is like if I sold any options, it would probably be cover calls or something. But I don't know when it's going to take off and when because uranium would take off and then it'll go down. Like we can go look at some uranium companies right now. I've been seeing this over the years that I've been investing in. So let's say, for example, NextGen, this is a company I do invest in. It's not financial advice. So NextGen hit 493. Then it went back down to 370, 362, somewhere around there. Oh, actually 353. Now it's popped back up to 517. So when I'm looking at this, obviously, I mean, that COVID low was just insane, 59 cents. Woo. So, yeah, obviously, like, I mean, you have these ups and downs. So we're obviously in an uptrend on a long term, but like you get these, like right now, it could be accumulating here and then it could be at freaking $4, next week. So it's like so it's like I'm holding for the long term. Like this isn't the move I'm looking for, right? Even if I bought at 358, this move is good, but I don't own a whole lot. I don't own enough shares to make a drastic life improvement, right? It's not changing my freaking like my financial life, right? So like getting that dollar and however many cents, like yes, it's a gain, but I'm in it for the bigger gains. Like I know the bigger gains are coming. So, you know, I mean, obviously this is a newer company, so we can look at uh, let's look at freaking what company we should look at. Uh, let's look at Cameco. I was buying Cameco at $15 and I'm mad I sold. As you see, Cameco, I mean, it was at 51, back then. This one continues to just go up. There's a lot of them that are still down quite a bit. Um, you know, uranium royalties. Uranium royalty was at $5.50. Now it's at $2.34. So that's less expensive than some of the other ones. So Cameco is obviously the big one. I mean UEC. I mean it's high in the last year. It's like what $4.50. Now it's at $4.16. I was actually buying them at $1 something too. I was buying them at like $2 over here. I remember that. So you have your spikes. Spike to $6.40, come down. So I mean, I could sell that, like make double my money, but it just depends on how many shares you got and how much capital you're looking to gain. Because then you got to wait a while before it goes down. So at uranium, I'm just waiting for some bigger moves on it. Um, Options are kind of like gambling in a way, but you do charts. I would say charts, not necessarily, but you do look at market psychology with charts, and you can look at like the volume of what capital's coming in, flowing out, and such. And so, kind of gives you more of a like scientific way to look at it. I've learned now you got to buy heavy first, time in to make money. Yes, you do. But the key thing is you got to buy what's cheap, right? You got to buy what's cheap. Like these stocks I'm looking at are cheap on historical basis. Like there's quite a bit. I just started buying right now. This is one I'm accumulating. Natural gas. So the thing with natural gas was last year, um, people were anticipating a cold winter in Europe, and Russia pretty much had all they had the Nord Stream pipelines and everything that supplied natural gas to Europe. So we were expecting like a big spike. However, they had a warmer winter than expected. So the price of natural gas just came down. I mean, look at this. Um, you know, UNG was at 32 bucks in August of last year. Now it's at $6.78, but I think that it's going to go back up. If you look on the 5-year chart, it goes up, comes down, goes up, right? I mean, I think they diluted a lot of shares or something. So I think that's why that's like that. So natural gas is one that I'm looking into. Other ones I'm looking into, ENB, they do pipelines and such, pay a solid dividend. Right now, uh, so over last year, I mean, their high was what, 46 bucks. Now they're at 34 bucks. I mean, even at the pandemic, they were at what, 25. So it's not too bad. Um, so if you're looking at, historically, back in the last commodities bull market, it was at, 49 bucks. So, it's still fairly less expensive. And they actually pay a solid dividend though. So this is how you compound your money right here. 7.58% dividend. So you're compounding your money. I mean, obviously, I like Energy Transfer. This is another one I like. I mean, look, it's staying relatively, flat, right? I mean, yeah. If you go back to the last bull market, 34 bucks, cold, then it just plummeted 7 bucks. But this is what I'm looking at. The dividend, 9.54%. Now that's paying more than the treasury bills, all of that, right? Another one I like, EPD, another high earner, dividend payer. They do transportation and such for these pipelines and everything. They're at 26 bucks, dividend 7.58%. He said, yeah, man, 100 shares, a brick, minimum to start, 500 or 1,000 shares, most ideal. Yeah, and it just depends on, what companies you're buying. I mean, like if you go in and buy, depending on how much capital you're willing to put in, and then if you're going in and buying freaking uranium royalty at $2 a share, like you can get 1,000 shares pretty easy. But when you get to these more expensive things like ENB, Enbridge, or whatnot, then you're looking at a more hefty price for that. So, yep. All right, y'all. I gotta get going. I gotta wake up in the morning, go play some basketball, take care of my physical health. If you all haven't yet, be sure to click the link in the description to check out the New Orleans Investment Conference. Neophyte, when you gonna come to a conference? You should come to a conference with me at some point. It'll be dope to see some of y'all in person and everything. I actually had I had one person, well, a couple people from the Rule Symposium. They're like, "Hey, yeah, I'm seeing your interviews. I've seen your interviews and such." And so I had one lady. She's from she's I want to say Russian. She came up and gave me a hug. She was like, "Yeah, I love your channel and everything." And so yeah, it'd be good to on the YouTube space and the cyber universe, the metaverse, to connect with me at some of these conferences. So next one I'm going to be at is the New Orleans Investment Conference. All right. All right, cool. See you soon, Max. I'm heading out. All right, Neophyte. Yeah, that'll be good. All right, y'all. Y'all take care. I'm about to head out. Peace.